I'm Eiland Glover. I'm a co-founder and CEO of Kowala, as you just found out. And I want to talk a little bit today about what's happening in the stablecoin space. We're familiar with this in many ways, so we're going to cover the past and a little bit of what's coming down the line. So Kowala has been around for a couple of years, as you just heard, and we are a team of about 18 people at this point. Half of those are developers, and they hail from companies like PayPal. Some of them are Ethereum core devs, from Status IM, from CryptoKitties even. And we've been working to create something that we think is really necessary for the industry to take the next step. Right now, crypto is tiny. You know, we have experienced a lot of cool growth and a lot of buzz over the last period of time, especially the end of last year. But right now, it doesn't feel that way, right? We're kind of stuck. We're sort of receding a little bit. And so there are other asset classes in the world that are much, much, much bigger. Like, for example, the money supply, 90 trillion. Equities, 70 plus trillion. Derivatives, 540 plus trillion. Real estate, 217 plus trillion. We all know, we're here because we know that the token economy is going to take over large swaths of these industries, but it has not happened yet. And I want to talk about one main reason why this hasn't happened yet and what we need to get to that next stage. We think that the biggest obstacle to mass adoption is volatility. If you are a business person or if you are a regular person, you know that you cannot run your life or your business on a currency that's going to drop 30% from one day to the next. It just does not work. The numbers do not pan out. If you are a blockchain-based project and you have your own utility token, many of us are also realizing, wait a second, our economics don't work. Our projects that we're working on, that we're going to launch on, let's say, Ethereum, may not work because we don't have a stablecoin, or maybe because the price of Ethereum is so volatile that we can't predict our gas prices. We don't know what it's going to cost to run our business. That's not cool. That's a bad thing. So what we're working on is to build some of the vital infrastructure that is necessary to get over these obstacles so that we can expand into these much larger territories. We've had stable tokens for a while. The biggest 800-pound gorilla is Tether. And Tether is a fiat-backed stablecoin. It controls about 90% of the 2.5 billion odd market cap today. And it represents, I think, a very vital piece of our industry. It's a great trading tool that's been very important for the expansion of the industry so far. But it's like a Gen 1. Okay, now we're on to almost Gen 4 in terms of stablecoins. Here's the way that we think about the evolution of stablecoins. So Tether and now TrueUSD, fiat-backed currencies. It makes a lot of sense. DAI is also asset-backed, but it's backed by Ether instead of by fiat. And then you have projects like Basecoin and ours, Kowala, and our KUSD stablecoin, that are not asset-backed at all. There's nothing behind them at all. Zero. So that sounds, at first, I think, a little bit scary. You know, that sounds like it would be a big disadvantage and something that you wouldn't really want. But we have to remember what the true meaning of the word fiat is. The true meaning of the word fiat is because I said so, right? A government says, because I said so, this is your money. And when we think about it, you know, we just heard a little bit about the history of money, but when we think about it, what is money, what is its use value? You know, we need a couple of things out of money. We need for it to have the buying power tomorrow, roughly of what the buying power that we had today. And we need it to be fungible. We need it to, we need merchants who sell llamas to accept it, right? Or else we can't run our lives. So our thesis and what we've built is a way to have that use value while retaining all the things that we know and love about cryptocurrency. We don't have to give up decentralization to get stability. We can have it all. And I'm going to talk a little bit today about this new type of cryptocurrency in the marketplace, how it works, and how it's going to be advantageous for you and what you need to know about it. Here's a really complicated data table. I'm going to try to simplify this and move through it rather kind of quickly. The first several rows I've already hinted at a little bit, so I'm going to concentrate on the bottom half. These are the things that really distinguish non-asset-backed cryptocurrencies, and stablecoins, I mean, from the previous stablecoins. So on the one hand, you have to think about how do you achieve stability? Tether achieves it with essentially an IOU. You stick dollar bills into a bank vault, they issue a cryptographic token against those dollar bills, then you go out and use them in marketplaces and exchanges and so forth. DAI uses Ether in a collateralized debt scenario. So you put Ether into a smart contract, you take out 70% of that or some odd percentage of it in terms of some kind of stable coin, and it's backed by the Ether. The new tokens like Basecoin and ours, KUSD, use algorithms, right? Just like we do with Bitcoin. We can trust in math, and we can trust in market forces. And those are the two things that you must harness if you want to create a non-asset-backed stablecoin. Mathematics and free market economics. And you have to design an incentive system that incentivizes all the right behavior in terms of your miners, traders, individuals, and so on, everyone in the ecosystem. So one key component of that, we think, and I'm going to talk about that in a little more detail in a second, is burning. What does burning mean? That means that if you're going to have an autonomously stabilized cryptocurrency, it'd be a good idea if it was able to burn some of its money supply, right? So it's really easy, we know from the history of money and from many unfortunate regimes throughout history who have printed too much, that increasing money supply is relatively easy. How do you decrease it? So burning is a way to do this. That is, we actually remove money from the money supply. Adoption incentives. I mentioned a moment ago that Tether's business model is to take real dollars, stick them in a bank account, issue coins against them. Where do you make money with that? Where's your margin? Maybe you have a tiny transaction fee. If you have a non-asset-backed stablecoin, your margin it matches the best business model in the history of mankind, which is seigniorage, right? Being able to issue your own money. It's a robot that is going to issue its own money and subtract its own money from the money supply based on its price in the marketplace. When it issues that new money, it's based on demand and use value. That is newly created value that, in our case, goes to our mining token holders. So one of the cool things that you can do if you have 100% margin is you can incentivize a network. You can incentivize exchanges, you can incentivize users. You can share that wealth, and you can do a lot of really cool things to drive adoption and wallet share. Finally, the focus among our company, Tether, and all the other projects has been the US dollar to start out with. And this is for obvious reasons. This is the biggest money brand in the world. It's got 70% of the narrow money supply, so more than 15 trillion. And so it makes sense to start there because a lot of the world thinks in terms of US dollars. But Tether's coming out, or maybe they've come out already with a Euro version, and we plan on coming out with tracking stable coins that track all of the major currencies in the world, because we believe that many of those different currencies have different use cases. So I want to talk about one layer of stability algorithms in our model. I mentioned before that you have to control the money supply in a totally decentralized, autonomous way. We don't have any control over demand, but the system can control its own money supply. So I'm going to break that down a little bit. What you see here is a chart of what KUSD might look like on an exchange. The yellow line here in the center is $1 US. That's what it's always going to try to get back to. And the demand, of course, makes it go up and down on the exchange. So the green and red, the green means when it's above $1, and the red is when it's below $1. So I want to talk about the things that happen in these different circumstances. So here in this first section in the green, the demand for KUSD is higher than the supply. People are willing to pay slightly more for it on the exchange. And what's going to happen is that information is going to come back into our blockchain via a decentralized oracle, and the blockchain will automatically begin to do something. It's going to say to itself, you know what, I don't need to be at $1, I want to be at $1. So I better start minting more KUSD. It's going to mint that new money automatically, and it's going to distribute it to our miners. They then, some number of them, have to decide on their own to turn around and sell that on the exchange. That increases the money supply, and if demand is the same, or it's not outstripping the new money supply, then that price begins to come back down to $1. So what about when it dips below $1? Let's say that the Chinese government comes out and says it loves Bitcoin, and it's going to make it the second ranking currency in China. I don't think this is going to happen, but let's say it did, right? So people might want to sell. They might want to get out of our stablecoin really fast and get into Bitcoin because they anticipate a rise. And if they want to get out of it fast, there may not be enough demand to absorb that KUSD they want to sell. They might have to settle for 99 cents or 98 cents. And when they do that, that's cool. Other people can come in and buy it, but what's going to happen with our system? How does it remove money from the money supply? What will happen are a couple of things. For one, the block rewards stop. It doesn't make sense to print money if you're trading below $1. That doesn't make any sense. So those stop. And also, there is what we call a stability fee that's instituted. This is a tiny, in almost every case, a very, very tiny transaction fee that is placed on any on-chain transaction that takes place during this period of below $1. It's a small number, but multiplied by many transactions over time, it's a very, very powerful way to remove money from the money supply. That money does not go to us, it doesn't go to our miners. Instead, it goes to a burn wallet. This is a dead-end address from which it can never emerge. Importantly, everyone in the world can see this dead-end address, and they can see this burning taking place. So the mechanisms are transparent, and the money supply increases and decreases are transparent to the entire world. This is one layer, as I mentioned. There are others that I don't have time to go into, but we'll keep moving on. I mentioned a moment ago that burning is really, really important. It's another thing that I think sounds really scary at first, but I want to explain why it's so important that our blockchain can remove money when it needs to. These stability mechanisms that I've been describing to you are effective at returning that stable coin back to $1 given time, right? Given time. They're not immediate. So how do you actually provide a very, very stable token to people that's stable all the time? It's not us, but it's the market. It's a market informed by what is going to actually happen in terms of the stability mechanism. So if you can predict exactly what's going to happen with the money supply, because you can read the code, you've seen it happen in the past, guess what you're going to do if KUSD hits 95 cents? Some number of traders are going to be a buyer. They may think to themselves, hey, I'm going to make 5 points on my money. Maybe it's going to be a few minutes. Maybe it'll be a week. I don't care. 5 points on my money every week, I can live with that, right? So we have to, the simplicity of the model and the effectiveness of the model has to be simple, and it has to be clear to traders so that you can have an effective peg to any currency using a non-asset-backed stablecoin. So I also mentioned that this is effective at removing significant portions of the money supply over time. And here's some examples. This is with some conservative assumptions. The blockchain will remove 8% of the entire money supply in 30 days or 40% in 180 days, okay? So that can give traders and everybody in the ecosystem the confidence that if something really goes wrong, it's okay because the blockchain will burn enough money to return itself eventually, okay? In the knowledge of that, however, the traders don't really let it drift too far from the peg in the first place. All right, we're running low, so I'll finish it up. So we view ourselves as an infrastructure provider. We want to provide tools for you that you can use and help your businesses function better. If you're interested in talking with us, if you need a stablecoin, please come and find us. If you need an Ethereum based blockchain that's super fast, that also features a stablecoin, we want to talk to you as well. Thank you very much for your time.